3 p.m. on Tuesday, November 11th. 11/11, make a wish. How's everybody doing? Um, had this thumbnail, the everything bubble. Sentiment rolled out last week. We still have everything tentative this week for US data. CPI, PPI on the calendar for Thursday, Friday. I just said this in one of my last classes that I just taught this, today. I wouldn't be surprised if we don't have any data. I know that the market got a little optimistic on the government shutdown likely ending. I think betting markets right now show between the 12th and the 15th. Well, Friday is the what? Friday would be the 14th. Part of me could see that the market does not get the data, so we can't roll out any CPI or PPI data. Maybe it comes in late and laggy. I'm not even sure what the last print that we saw where the headline CPI was 3%. We also have core CPI at 3%, headline CPI at 3%. That was a couple weeks ago for the, I guess it was the June or July data that printed in September, or I'm sorry, October. So anyway, it's on the calendar, still tentative. I doubt we're going to see the news. So let's go to the calendar here. Let's go to Thursday, Friday. So Thursday, tentative still. The Bloomberg calendar shows the previous as well as showing all the year to years. So let's go to the Bloomberg calendar and go Thursday, Friday, apply. And let's look at 8:30. So here it is, on the calendar, but there is no forecast for this week because it is tentative. This doesn't even have a disclaimer that there's, government shutdown. It says right here, government data may be impacted by the shutdown. Tentative events are subject to delay, revision, or cancellation. It wouldn't surprise me if this is still delayed, so we don't see any data on Thursday. If they delay this into Thursday, Friday, that means another week with no inflation data. And if the government shutdown is going to end, which we're in the longest one in history, the markets don't seem to care that much. The market's optimistic the government shutdown will end at some point. I do think that whatever happens from the healthcare side, SNAP benefits to back pay, labor, getting some data back in the markets will be a good thing. I really think that the markets probably have more of a tailwind with the government reopening than a headwind. The fact that market is still very resilient, considering we had a 4+% correction. This is what I posted in Telegram. So S&P corrected just over 4%, Nasdaq corrected just under 6%. Pretty clear rotations happening in stocks right now. Recognizing that basically being concentrated, 40% of the market is all in Mag 7, and of that, I'd say 10, 12, 15% of that is in Nvidia. Nvidia has earnings next week on the 18th or 19th. And that's obviously going to be a big factor, whether it's positive, negative. I mean, earnings plays in NVIDIA are not necessarily directional, but there's obviously a lot going on to how it moves or how it doesn't move. And it will impact whether or not we're going, higher or lower in the overall markets. Mags, we are still green. We had our pullback towards the 50-period moving average. I mentioned this on Monday in all the live sessions. That Friday pullback that we saw last week, the SPY hit the 50 period and bounced nicely off the 50-day moving average. So SPY, if it updates here. Data, Bueller, hello. SPY, QQQ. There's Qs. So bounced off the 50-day with some volume, which was impressive. Here's SPY. Not updating for some reason. SPX updating. That's a pretty big jump on the S&P. Why do I think that the S&P is looking a little bit better, more robust, and possibly, breadth-wise improving? It's 500 companies versus 100 tech companies. Dow. Dow has reflexively rallied pretty much back to all-time highs. Not a bad move for the Dow. The Russell came back to the low of this October 10th candle, held and closed above that, which was a good kind of safe level. I think this is kind of an interesting look for this to see maybe something along these lines where we have support here. We have slightly higher highs. If the lows can hold and the Russell can continue to catch up, maybe through an additional rate cut by the Fed in December, we'll see where that goes. Technically, I could see small caps still doing pretty well. If I extend this out, this might be a little messy on the technical side, but I could extend that move out if we have a cup and handle. That cup and handle would be, it was projected off of like the recovery from April. If I measure symmetry from the COVID low, low to high, higher low to higher high. If we break, I mean, some technicians say there's no such thing as a triple top. If we break these highs and continue to go higher, I think small caps have room to get to like, 300. I mean, you see it right here on my chart. IWM breakout symmetry, somewhere between either this exact low or where I have it projected off of this low to high. So it's either taking uh, this low and this high, or it's taking this low to this high. So that little difference is where I'm getting the difference in that symmetry up top. Okay. But again, like I would stay, destination 300 on IWM if that's where I think we can get to. And that's just a pretty good technical measurement. Um, but we'll see. I mean, obviously, if the Russell's going to perform well, we're probably going to still see S&P and Nasdaq do well. In addition to that, okay. So markets today, here's where we're at. Pretty sticky around 68.50 this morning. It was pretty jumbled. We end up having some positive gamma on the day. We are still trading in between the 50% moving averages, 69.05, 69.10. I have a bonus trade there. It's not going to get filled in the final 40 minutes of the day. I didn't get filled on my daily profit lit today. I traded, I've been trading it pretty conservatively, but we've been getting really good fills and profits intraday on our 0-day daily profit play. I did take a nice trade today for my double ups. We ended up grabbing about, 20, 25% profit. And is anybody still holding that trade, by the way? Did I take that? No, I didn't. I did take the Oracle trade because I didn't want 200 shares. If something happens here where Oracle, the one thing that makes me nervous about Oracle is it is the, one glowing, poster child for, oh my gosh, this AI stuff demand is so real. But what concerns me is that Oracle is taking on debt to fuel its AI build out, unlike others that are doing it with cash flow and percent of sales. So I don't like debt programs to add more to this AI build out. So the trade I looked at was we did a 190 by 180 ratio spread and then added in a 170 put. I truly don't want to own 200 shares of Oracle. So it was a trade that would have offered maybe $2.30, $2.35 of credit, but I don't want 200 shares, even though the probability of assignment is low. I just don't want the shares. So I'm going to pass. I've already taken a couple of trades and ratio spreads and naked puts for Project Options Edge. I'm not going to add to the exposure. This also is in a spot technically where if we are going to stay in between the 50 and the 200 day, this is not the time that you want to be a hero, right? If we're inside of this and this breaks lower, I'm in what looks to be a bear market. What could roll over into a bear market? And here I am like, hey, I've got a naked put on Oracle and I don't really want to own the shares. Also, price to earnings wise, it's more expensive than Microsoft. And that's another kind of caution flag for me as well. So I'll hold off. It didn't fill. I looked at the trade. I think I put like a 240 credit in 235. It didn't take. And then I just made the decision. I don't want 200 shares. 100 shares is fine. 200 shares, no thanks. Okay. What's your take on Burry short? Short for what? Palantir? I mean, you got to be careful on what that headline stuff gives you. It's like, yeah, he might be short for like one trade, but he might have an overall stake and it could be a short that's against a hedge. I don't know. I don't think Burry is like, big short on AI. I don't. I think it was a one-off trade that made some headlines. So we'll see. I mean, there's probably better rotations than Palantir, which is trading at what type of valuation? Palantir, Snowflake looks good. Earnings forecast to grow. I mean, all this is good. But when the price to earnings is 400 times earnings, it's kind of la la land. And I'm not saying that it can't be better, but this is disconcerting, right? 193 current price, fair value 72. I have no business wanting to buy current price levels of Palantir. So we'll see. If it comes back down sub 100, then sure, I don't mind establishing new positions on Palantir and taking advantage of a super high IV. But until then, I'll wait. So I just think there's better places to put my money than something that's potentially super overvalued, and the market might get some nasty momentum on it to the downside, and I just don't want to take the risk. Follow them on Estee Lauder. What's the ticker there? EL. Estee Lauder. Yeah, that's cool. I mean, if you ask, it's like, are you short Estee Lauder? I'm hoping if you're short, it was like 2022 to now. Otherwise, I mean, here's what I look at in Estee Lauder. Let's go back to EL. Estee Lauder. Dividend not well covered, high level debt, insider selling, below estimated value, earnings forecast to grow, price to earnings. I mean, 2 times sales, not crazy expensive. Fair value 99. There's upside potential there, discounted cash flow. It's already had a massive correction. Let's look left on the chart. I mean, I don't love the stock. I mean, if like, here's my thing. If you see a stock like this, I would call that questionable, if not dead capital. Like, what is it about this stock that declined 87%? Yes, there could be some puffs of greatness left in this level if it bottoms out, but why is this stock down? Something is going on internally where this stock sucks. It's down almost 90%. I don't want to throw capital at a trade like this and think, oh, this could be a good trade. It's super discounted. Eh. I mean, what's performing is like, look, we are clearly in a K shaped economy. Stocks do this, and then there's stocks that are doing this. Okay. These will continue to either ride higher and these might stop sucking. But if we have a rotation, be prepared for this and this to revert into somewhere in the middle. That's what rotation is. And I wouldn't be terribly surprised if we see a pretty, heavy rotation outside of tech, limiting that exposure, maybe more into energy, maybe more into value plays, just because I think that's where money's going to be treated better. So we'll see. And a couple things I'm cautious of: Cape Shiller ratios at 40 plus, valuations near all time highs. Forward price to sales in the S&P is near all time highs. I just think that your expectations for the market to produce 10, 15, 20% a year, I think you have to set proper expectations. I wouldn't be surprised if the market, and this is why I had this thumbnail. Look, I think the pain trade is more to the upside than anything else. Right now we have U of M sentiment at like literally bear market recession type lows. We have AAII sentiment that continues to print like pretty elevated bearish ratios. And I think if the wall of worry is what this market continues to climb, that is the contrarian play. Everyone's worried about a recession. The market's going to climb that wall of worry. Everyone's worried about the AI bubble. It's going to keep climbing until the AI thing will maybe drive us into the everything bubble, right? I think that we would be surprised to see if we think this is a bubble, but we're being led by pretty strong fundamental companies. I don't think this bubble is even at ridiculous levels where it's like, holy holy crap, we're in a bubble. It seems like it, but I wouldn't be surprised if the market has, let's say it blows the top off and it's up another 10, 15, 20% from here. Let's say from the bottom in 2025, the April bottoms, let's say the market's up like 50 to 100% off those lows. Yeah, maybe I get a little bit more bearish on the technical side. And I think eventually, like, the everything bubble is not even close to these current levels. I mean, again, I don't know, but this is not a time that I want to be shorting when I think that right now government reopens. That's probably a tailwind for stocks. I think if the the buybacks are back in, so that's a tailwind for stocks. A rate cut, fiscal policy, that's a tailwind for stocks. This blackout in data where we don't really have anything to be negative on. It's like, yeah, nobody knows what inflation is. And then when it comes out, does anybody care? Oh, that data was 2 months ago. It's improving. Shelters are coming down. Rent prices coming down. Shelter is a big contributor. It's like 40% of CPI. So if that improves the next time we see a CPI data, if it's not printed this week, whenever it happens, it might be like, oh, headline CPI at 3%. Maybe it's 2.9, right? Maybe it prints at 3%. So it's showing it's not going up month to month. So anyway, I think the pain trade is up. And I've said that a lot this entire year. I just have been cautious through September, October when the market has really had no seasonality. Typically, we see, I don't have a chart ready, but if we have like a typical seasonality, February, March, April, little pullbacks, summer push, August, September, summer push, or end of the year, Q4. So we typically have pullbacks between February and April, August to September, October, and then Q4 into November, December, pretty solid to finish the year. This is what a typical season looks like in the S&P if we're going to go for higher years. 80% of all of our market years have been bullish, 50 plus percent, like 55% of days and weeks are bullish. I mean, that is your house edge. But we have shifted all this because the reality has been, let me change the color here. Can I change the color? Maybe, maybe not. Anyway, let's say this is what the typical seasonality looks like. Well, we basically had to start the year off, January, February sideways, very aggressive correction in April. And then we are up here. We have not stopped. We had a little correction in October, right? I guess I should shift that over a little bit. So we go January, February, April was the big down month. We turned over in February, rolled hard in March and April. Once we had the big pivot in April on the 7th, back up to these highs. August and September still goes higher, still goes higher, still goes higher. October, little correction. And here we are, just off the highs. So let's kind of shift this over. Okay. So we haven't really seen the traditional August, September weakness. I think maybe sideways is the direction we get, especially if this shutdown continues for the next couple of days. I think government reopening is the tailwind. I really do. I think the market will continue to still try to print highs. And I say that because technically that climb we saw from Friday's close last week into this week's open and pushing, we are still edging higher. Okay. This was Friday down, pivoted hard in the afternoon by noon, and this thing was back up to do an entire gap fill. That move was 66.34 to a close of, look at this. We are up 200 plus points since Friday's low. Have we had any news? Not really, not concrete news. We just had I think the government's going to reopen. Market likes it, And here's the other thing I'm talking about with the sentiment surveys. It is a pain trade. And if everyone, this is, again, time to be concerned would be if we see ridiculous prints. So here is the AAI sentiment survey that prints every Wednesday. Here's where I think I would be concerned. Can everyone see that the print last week was a 38% bullish, which is a 6% reduction from the previous week? The neutral camp jumped from 19 to 25, so people are still kind of on the fence. And the bears are still persistent around 36%. Historical levels, 31% bears, 37% bulls. So it's the neutral camp that's been fluctuating. The bulls are actually higher by about 5 or 6%. Where I get more concerned that a top is coming is if the bears dip to 25% or 20% and the bulls climb to 45 or 50%. Then I'm looking at a near-term top. So right now the pain trade is the market is still bull or bearish. The market is 36% bears is still pretty high. Okay. The University of Michigan sentiment survey, you can go to the Forex Factory calendar. This printed last week, I think on Friday. This would have been a Friday print last week, I think. Let's go Friday the 7th. University of Michigan. Okay, so here's your inflation expectations. Here's sentiment. So 53.6 was revised down from 55 to 53.6. That was a lower revision. We forecasted 53, came in 50.3. Take a look at this on a graph. I'm going to go back in time. Okay, this thing goes back pretty far. Look at this. Let's go back to 2008. Even during the great financial crisis, our sentiment has not been this low. All right. We had super high inflation and a literal bear market for 9 or 10 months. That was the next lowest level. Even through the great financial crisis, we weren't this freaking low on sentiment. Okay. Usually sentiment is not this low when markets are sitting at all-time highs. And I do think that the market will push traders and investors to pain and discomfort where in order for us to get a real top, it's going to be when the market is probably blowing off tops and it's geez, if you can't beat them, join them. I can't be a bear anymore because I'm just wrong. So again, I think the pain trade is surprisingly more bullish than what we have right now. I think that there is a pretty consistent Trump put in the market, meaning if something goes bad in the markets, he will say something to spin it. We literally had a 4% correction, and what came out news-wise, government reopening, we're doing this, tariff dividends, blah, blah, all this stuff just comes out to just throw out a barrage of positive news that's whether it's real or fake or it's wishful thinking, it's in the market and the market digests this stuff. So it just keeps getting built on fanning the flame of optimism, even though sentiment is sitting at terrible levels. So I think the market's ability to climb the wall of worry will continue. I just had a live session today on my waterfall income, and this, high to low, high to low, high to low, high. I could see this trajectory continuing to be something like this. Either we're going to continue to make these slightly higher highs, and this market just kind of snakes its way higher. Okay. Or if we do start to roll over a little bit, where maybe this October 10th low, it maybe goes up here, maybe has some slightly higher highs. It might go sideways, which is also very realistic. So the trade that we took today for waterfall income, We took a really good trade yesterday when the market was down near the low of the day. We put in a pending order to see like if we in fact do go sideways, we're giving ourselves like a 8, 10, 12, 15% room for error on my waterfall income. And I like those trades. So sideways is totally fine. I am cautious at these highs. I think if the market gets through 7,000, there's very little to hold it. I also know that 7,000 was a key December 31st quarterly collar trade from the JP Morgan investment arm. But I've also seen 2 straight quarters of that gamma pin has been blown through it. And what happens is this might be a resistance wall around 7,000, but if prices are going through it, market makers are hedging through those levels. And if we exceed it, it's like the ceiling's lifted and this, or I should say the ceiling's broken and there's nothing to cap it. So when dealers and market makers are properly hedged, they don't have to defend 7,000 if it's just easier to go through it. So we'll see. But I'm giving myself some margin for error just in case. What makes me nervous is I think at any given time, if the market's going to roll over on something bad and it really accelerates, then yeah, we are going to see probably a 5 or 10% correction that comes out of nowhere. But unless it happens with mags, I would say if you see a very nasty correction in mags, you also see something terrible in NVIDIA with earnings. I'm just looking at future catalysts here in the next week or two. If you see mags going down aggressively, if you see NVIDIA going down aggressively, if you see SMH going down aggressively, then we're poking some holes in the AI theory that everything AI is going to be great. It would show that there is some fragility. But if this stays firm and stays supported, this market will probably continue to have tailwinds. Right? Okay. All right. What else? Pain trade is up. Personally, the top's close. Okay. I mean, maybe it is. But based on what? You're talking about a top that lasts how long? There's so much doomsday out there. There's so much bearishness. It's why I think that it's not in, man. I don't think the top is in. Where I get more concerned about a top is if we spend, let's say we spend now until like January, February going sideways. Then I think we're going to a distribution phase, right? If we have something like this where price is rolling over and barely going higher, then that gives me more of an indication that this market's going to roll over. Okay. What usually happens in stocks and indexes is we don't V top, right? We V bottom. And so the scary part about tops is once this rolls over, it builds the structure. When these floors break, then the correction really ensues. But I do think that technically the market will give us, some evidence where it's not just going to drop. If it drops, we're probably going to see another V bottom, right? If the market does something like this, where it just, flashes down 5 to 10%, it probably freaking V bottoms. But if the market spends months sideways, barely grinding higher, having some ebbs and flows where it's like, up to all-time highs and then down 3-4%, up to all-time highs, down 3%. That to me is a distribution cycle that would be, yeah, the top probably looks more near. But I think this takes time. I don't think we just roll over. So, there's a lot of technicals here that are just supporting it. We're at the 2150 day. It's still holding. Okay. There's a lot of dynamic support to still be in the market, even we have a correction. And I spent, an hour and a half teaching my waterfall income class, which usually, even in a bear move, the markets typically have like these 8 to 10 or these like 10 to 15% corrections. And then we have these reflexive bounces. So even if the market were to roll over, okay, let's say that we, break the structure and it goes to highs and then it breaks structure and then rolls over here, that leg lower and that leg lower are going to be very painful, but they're usually not going to happen in a straight line, right? So measure the move, and then the bears have to either take control or wait to see where the bulls are at. There could be some demand in here. We have big picture levels and stuff, but I just think the crazy part is you have to be ready to protect your capital for anywhere between a 5 to 25% correction to still be in a bull market. If we roll over 25 to 40+%, then obviously the bull market is going to have to wait. But we could literally have like a 10 to 20% correction and we're still in a bull market. That's what's nuts. But I don't know what the myriad of things are that would like actually matter. And I really think the reason this market rolls over is probably something that nobody's talking about right now. If it's going to be a nasty spillover, like nobody's talking about it. So I think it's going to have to be something in policy. I think that there would have to be, what could be disruptive these next couple of weeks? Let's say the Supreme Court rules that everything we did for tariffs is unconstitutional. Well, that could be disruptive to the US, not necessarily the world. We all of a sudden remove tariffs. It's like, well, there's no tariff dividend, and the US is going to have to get creative on how the heck they're going to start, paying down our deficits, because that's essentially what the tariff plan was. Is we have a 6, 7, 8% fiscal deficit. Let's get tariffs going. Let's pay back whatever, or just reduce the deficits. If that doesn't happen, and you can't promise people tariff dividends, which I think is ridiculous. I don't know how that would be. I don't think anybody forgot that the stimmy money that people got back in 2020 and 2021 to the tune of maybe $1,000 to $2,000 a person or household. All it did was end up back in the markets, ended up in the hands of the few, and all it did was drive inflation higher. You think about peak inflation in 2022 when the Fed was raising rates. You had so much money in the system chasing so few things. We just ran hot with hyperinflation. That was our kind of modern version of hyperinflation. I couldn't imagine what $2,000 does now. I just feel like we blow deficits out. We, again, probably have another leg of hyperinflation, but it probably does boost assets, which is oddly enough like a tailwind. So anyway, I don't think the top is in unless the price action suggests that we're rounding out. So I'd be very cautious on this thing rounding out. Okay. Anyway, let's go elsewhere. Dollar index. Dollar index hit resistance around the 200-day moving average. This is one thing I'm cautious of with risk off or risk on trading. If the dollar retreats, then we get the markets to elevate a little bit higher. Okay. But if the dollar is here making higher highs and higher lows, once we clear this resistance, this dollar might actually surprise people to the upside. That would be a risk off trade, in my opinion. So I don't want to be long assets if the dollar is going to end up catching a bid and covering, getting all these shorts and squeezes to the upside, where everyone that's been so crowded and so bearish is now just going to have to, get knocked out of their positions. And that would be a surprising move back to possibly equilibrium. So if the market's from this high to low pulls back about 50% or so, once that's done, now is the momentum like just going to continue to go higher? So the dollar might also be a surprising trade. I think if the dollar goes up, it's not going to be a great thing for stocks. So we'll see. I could also see this bottom is not necessarily done. Maybe we spend more time doing this, going sideways, right? Sideways is a market direction. It's unclear. It's consolidating. It's difficult to see a sustainable move, but it's an environment we have to trade. So I will watch, but so far rejecting off the 200-day. If we keep making higher lows, I would just be careful that the higher lows continue to get some speed to the upside. If we squeeze higher on the dollar, that's probably a risk-off trade. Okay, oil. Oil still steady around like $60. I need oil in CL, which is crude light. That's my futures trade. I need this to stay above $50. It's looking pretty good. It's December expiration. Let me see here. CL. I'm up 86% of my max credit. I think this maxes out at 220. So I'm getting up there. I think if I'm over $200, I might just take the profit and close it down. Probably 205. I'll see where this, timing wise, it looks pretty good. I also have a $500 profit trap in here. Probability of profit is 98%. We have to have something pretty terrible happen in oil for that to, knock me out so I'll probably just hang on to it for profit. Also, that buffer of, a 50-cent profit trap might actually help. But we're probably just going to stay here at 60 and I'll grab the full 220. Natural gas. This is looking much better. I should be seeing some positions long and profitable on UNG. Let me double check that here. So UNG currently up about $700. We're just getting started. I've been reducing my cost basis on this. It started out as a diagonal spread. I bought the $5 call. I was, selling the 15 call, selling the 14 call, selling the 14 call, selling the 14 call. I did this 3 or 4 times. My debit is down to like a $10 debit net. So I've sold calls against this $5 long. My break even is around. I'm trying to think. My break even is probably around like $15. So we're getting closer. But I'm looking to see if UNG can maybe have another squeeze up to maybe $22 to $23. And I'll probably just take the profit. I am, I'm long on that $5 call out to 2027. So if we get a decent like push on UNG back to 22 to $23, that's a pretty good flip for me. Grabbing like $9 or $10 a contract, that's not too bad. So anyway, I think UNG is a pretty good long position over the next 12 months. Gold's been looking pretty good these last couple of days. I don't think this is the time to go all in gold. I think this is the time to still, play the dollar cost average game, high, low, maybe a consolidation window where you just go back and forth to highs and lows, or possibly a high, low, lower low. And I say that because in the context of a 3-year bull market going high, low, lower low, it rattles out all the weak hands at the top and it allows some dollar cost averaging at good technical levels and also a healthy discount. So if we pull back to this 200-day moving average, I still think this is from peak to trough about a 20% correction. I want to be buying some gold. So even if we go back up to highs, I am questioning the run. I think if we go back to highs, it comes right back down. I would prefer that we see a high, low, lower low against a 2 to 3 year bull run, and we just have a simple 1, 2, 3 correction. And I want to scoop up some more dollar cost average levels on gold. So I'm still long gold. I like it. I did take a huge position off between gold and silver for the last 2 to 3 years. Very bullish positions I've taken profits on, and now I'm starting to get back in and scale. Okay, silver. Silver is up 1.35%. I'm not sure why I'm not getting a feed here, but silver futures, SLV. I mean, silver right now, let's go XAU, XAG. I mean, let's bring it back. Where could this go? Well, if the gold versus silver trade pulls back to like 75.3, that's when this ratio has had some pretty good support. So I could see silver continuing to outperform. It doesn't mean either one has to like go down necessarily, but I mean, silver could have the upper hand, maybe outperform by about 6% or so. And then I would expect maybe things to stabilize and flip. But longer term, I still like gold and silver a lot. So there's SLV. I mean, it's just a comparison of gold versus silver. I've been heavier silver than I have been in gold, but technically, I mean, a 3-year bull market in gold and a 2 to 3 year patient bull market in silver that still looks like it has a lot of upside with all-time highs being broken. Bitcoin 100K seems to be holding pretty firmly. Let's see what happens. I still think there's room to kind of again shake out some loose hands. Maybe Bitcoin drops into the low 90s. That would not be fun. I mean, I'm going to take on a little bit of drawdown for some of the dollar cost average positions I have on Bitcoin. IBIT, I might take some assignment. I hope that I don't necessarily, but it's okay if I do. Premiums are pretty generous, so I could obviously repair some of the trades. But potential technical pullbacks into like the 90s. Okay, like 90 to 88K. I could see that being a support. If we start to turn up, if we see like government reopening, inflation data, the Fed cuts again, blah, 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 start to fire up the printing presses, whatever. Bitcoin can quickly turn to a bullish trade. Risk appetite's going to have to maintain. I think the Nasdaq going higher drags Bitcoin higher. I think the tech trade, the AI trade still drags Bitcoin higher. If we see a heavy rotation, out of AI, if the Mag 7 drops, if semiconductors drop, Bitcoin's probably under some pressure to fall a little bit lower. I still think 90K is strong support. 90K back to 125 or 126 could happen quickly. We could obviously break to all-time highs as well. But I'm going to be patient. It's not fun watching the S&P and the Nasdaq, just be within a whisker of all-time highs, and Bitcoin is down, 15, 20% from these recent. I mean, it's down 21% from the recent all-time highs. So still in kind of limbo to see like, is it supported at 100K? Seems like it, but it also could break, cause some more pain. I just think there's so many financial instruments running right now with the premium selling on Bitcoin. It's just suppressing volatility and not allowing this thing to really run higher. So again, technically supported around like 100K, 90K. And after that, definitely looks a little bit more suspicious if we're breaking through, 85 to 80K. I'm not saying it's a bear market. I'm just saying like it's going to get a little bit scarier. So I'm hoping that's not the case. I'm hoping either we hold that 100K level or we hold about 90 and then we see what's next. Okay, what else we got going on here? Germany, Brazil, and Latin America have been doing really, really well. I don't know why this feed I'm getting some like slow feeds here. FTSE, my gosh, man. The UK is just ripping to the upside. Are they doing it at the cost of their currency? What's currency strength doing? So Swiss really strong today. Pound Aussie weak. Euro and New Zealand. But man, Swiss got a nice little pop today. But FTSE making some all-time highs. Let's check pound dollar. Pound dollar pulled back to between the 38250 on this latest swing from April to here. I don't know. We'll see. I think FTSE going higher is great. I mean, if you've seen the FTSE like climb, I mean, this thing's off those lows from April. FTSE's up about 31%. It's not quite as high as the S&P, nearly 40% recovery, 50+% in the Nasdaq, but looks healthy. Higher highs and higher lows, dynamic support holding that 21 and 50 period moving average. DAX, which is not updating. Here's FEZ. I mean, kind of rounded out. If we gap and go higher, like great. Often we're running to higher highs. Argentina, that was a bailout trade. I wanted to buy this one. I didn't. Whatever. China still looking good. Let's see if China can break some all-time highs. Not all-time highs, but recent highs, and see if China continues to run. Brazil, yes. Brazil's running pretty solid. Latin America running pretty solid. I'm long on both those ETFs. It's looking pretty good. Mags, this is kind of the, I don't know, this is the big concentrated, elephant in the room. Is the world going to stay long Mag 7 with crazy high concentration, or is the world going to try to rotate away from it? And it's not money leaving the system. It's money rotating to other things that are less expensive, things that are not as overly valued, and maybe some bargain shopping. We'll see. But something important to watch would be Mags, SMH, and then of course your indexes. Apple pushing well today, getting near all-time highs again. Amazon had a great blowout move through earnings. That was an awesome trade to get to all-time highs on Amazon. That was well above what the earnings expectation was. Broadcom still off all-time highs, but again, pretty well supported off the 50-day moving average. Google right back up to all-time highs. Meta, we took a winner today. I think closed out this morning. Or no, I'm sorry, Netflix. Sorry, Netflix closed out for a winner. Meta, we're still sitting with a 610 by 615. That was a bonus trade we took. I think it was in one of these YouTube sessions. And that trade is a bonus trade that should be up about 40 to 50 bucks. Meta is here. So it's up 60 bucks. I've got to take profit at 100. So 340 credit out of a 240 debit. It's about a 40+% winner. So 100 out of 240. That's a 41.6% winner. I'll see if it gets there. I just need price to stay above 615. If Meta tries to come back and gap fill, I'm not getting a feed on it right now, but if it come back to gap fill from earnings, that should be pretty good. Microsoft, I mentioned this yesterday. I looked at this trade. It must have been in the Gamma report. I ran that session at 2 p.m. yesterday and ran long. But Microsoft, I looked to price out, just doing some naked puts or doing a ratio spread. It just didn't offer the premium that I wanted, so I'm pausing. I thought this was possibly a good trade. If you like Microsoft right here, then a bull call spread going higher, that's probably a good trade. Right? If the market's going to make higher highs in the end of the year, Microsoft looks pretty good to do the same thing. Is just kind of high, low, lower high, lower low, head back up. You just need price to stay basically above like 505 or 510, whatever the sell side is of your bull call spread. So not a bad trade. Obviously, it was down to 490, 491. So like 490, 495 would have been great. You're already in profit. A 495 by 500, a little bit better. So I'll see. I don't love the trade right now. If it came back down to like 490, maybe I take that trade. Netflix, we had a 1075 by 1080 bull call spread. Took $100 out of that today. Nvidia earnings coming up next week. It wouldn't surprise me if Nvidia doesn't have any real direction. There's so much anticipation into earnings. This was the last earnings move. It didn't go anywhere. And then it finally went higher. If earnings is like this huge event, but a nothing burger catalyst, it just kind of stays range bound. We will see. Okay. I've got some ratio spreads. Let me see what I've got exposed on NVIDIA. A lot of them are pretty low. I've taken some naked puts off the table. Here we go. So I have some shares, selling some in the monies. I do have a put that's pretty much worthless, but it was cheap. What else? Project options edge. We did a 150, 140, 130. That is a ratio spread plus a naked put. That's up 76% of credit. Max profits 495. I mean, I could see it holding. It's like, I'm curious as we get into earnings next week, I'm probably not going to make a ton more profit on this trade. Even though it's another week out, I don't know how much higher this is going to get in profit. I bet this would be a lot better for me if NVIDIA, surpasses earnings, drives the market higher into the end of the year. And all of a sudden, this 495 is going to be, max profit. I still have a 97% chance of profit. Would I consider owning NVIDIA shares? Maybe. Do I want to? Not necessarily. If I own the shares, it would be a 135 minus a ratio spread. So that would be a 10 wide. So it'd be -5 because I'd have 200 shares and then minus about another 250. So I would own shares on that project options that trade at 127.50. That's not a bad discount. So from highs down to 127.50, I'd have a 40% discount on Nvidia. Problem with the stock is if it rolls over, this thing might just be absolute like a dumpster fire. And I don't know. I don't think it will do that. But if it does, this is one of those stocks where when it starts to roll over, it could roll over and just, you know, catch on fire to the downside. So I don't think it'll do that. It is literally like the number one company in the world. We crossed 5 trillion. It should take a lot more than just a negative earnings print to have Nvidia drop, 50+%. So I think it stays somewhat resilient in here, right? And it just might not perform very, very well. But if it just stays resilient, I mean, that still kind of keeps the buffer and kind of the positive gamma in the markets. So we'll see. Tesla 439. I've done some pretty creative trading on Tesla. I've done is kind of some heavy premium selling. I'm still up about 25K on Tesla right now for a lot of my accounts. This is 25K on this account. I've got like 7 or 8 accounts that I'm pretty active on a Tesla. So I have some shares. I've got an in the money covered call. I've got another chunk of shares that's covered out to 460 or 470 with an at the money. I've got 111s for some hedging. I've got ratio spreads, modified collar trades. So I mean, net doing pretty well. Just going to monitor Tesla. This is probably a stock if we have the big like Optimus AI, humanoid robot rollout, autonomous driving. If all these things go well, I think Tesla starts to get pretty ridiculous up maybe to 500 plus. I have a take profit on the shares that I own at 950. I think that Tesla, maybe gets up to $1,000 in splits. I'm going to give it time to get there, but until then, sell some premium. I did a buy at like 450, sold a 460 covered call, got over 26% premium on that trade. Now, granted, I want to also have some downside protection because we also know that this is very volatile. So if somehow this is a rally into resistance and this thing rolls over, let's say we just go choppy, and all of a sudden it rolls over. Well, I don't want to be stuck being a bag holder all-time highs. So I have puts, I have protection. I've done some creative option trades to lower my cost basis a little bit. But big picture wise, I'm trying to stay pretty bullish on Tesla. I think that this could be one of the biggest margin companies that we have. Nvidia's there, but I mean, we're talking autonomous vehicles, AI, full automation. I could see Tesla, building like literally dark factories, which is there are no humans and it's fully operational 24/7. I could see Tesla doing something like that, whether it's in automotive space or it's an energy space or it's AI creation. I don't know, humanoid stuff, whatever. So that's the optimistic side of Tesla. If you treat it like just a car company, then everyone hates it because it's overvalued. But I think it's just more than that. I think investors know like it's more than a car company. It has been for a while. Berkshire. Let me see. I think I took a screenshot of this or I took a snapshot. Let me check something. Here is Stimmy checks, Berkshire. I just listened to it today, actually. Berkshire's like 31 or 32% cash reserves, some of the biggest on record. And they have been a net seller and just building cash up since like late 2024. So going to the stock here, look, if the market's going to roll over, Berkshire is going to roll over with it. I don't think that Berkshire goes up while the market goes down, but I will say that in the potential chaos, I think Berkshire is going to survive. I think that they'll probably be in a great position cash wise to buy everything on the cheap from Buffett's kind of traditional valuations. It's a time to be cautious, right? Be cautious while others are greedy. Or what is it? Be greedy when others are fearful. Be cautious when others are bullish. Or paraphrasing, but you get it. So I think they come out probably better than most. It's just I have no idea what the correction looks like. So is it range bound here, and it kind of rolls over? Maybe. Does it break and go down with a bigger market correction? Maybe. But bigger picture, I mean, I would probably take a Berkshire at a 20, 30, 40% discount versus taking like a Meta at 30, 20, 30%. I think Meta, if it's going to fall, we're talking like 40, 50% corrections. Tesla, 40, 50% corrections. Nvidia, 40, 50, 60, percent corrections. So just a little cautious, but I'm not bullish on Berkshire. I think we have maybe some more chop in here. They are underperforming in the AI space. I think that's been some of the critique or the criticism that Buffett has had is, he has been a net seller of stocks. He's been raising cash. The markets are still sitting at all time highs. This AI bubble is just getting started. Blah blah blah, and they're sitting on 32% cash. So I mean, they might underperform, but when it comes to um, disruptive chaos that the markets might show in the next couple of years, Berkshire is probably equipped to handle a lot of the craziness. Okay. Bonds. So bond market was closed today. TLT was open for trading, but bonds should have been closed today. 10-year yield. Watching this carefully. I do have a concern. I mentioned this before. I'll share this a lot in my November 17th session. I'm doing the A1 trading. The Fed has cut since this point right here. The Fed, if we go into a December rate cut, that'll be 1.75% that the Fed has taken off of the cash rate and taken off the short term or the short end of the curve. Okay. My concern is that the Fed is cutting rates and the markets, bond markets and bond yields are responding like, who cares? You guys are cutting rates. This is, we want risk premium and we want higher risk premium because global PMIs are rising. We're probably going to see elevated. I'm not going to say rallying yields, but I would say elevated, which means that this essentially means the Fed is influencing the markets with literally zero influence. Like if the Fed is cutting rates and the markets are not trending lower with yields, that just makes everything the same. In fact, it's actually 30 basis points more expensive on the average move since we started cutting rates in September 2024. So, the big bears out there, this is a huge concern. Like, oh, the 10-year yield's going to go to 5%. It's going to break. Yeah, it will. If we go to 5%, then there is no growth. If we get to a 5% yield and this thing goes up another 90 basis points, we will have little to no growth in the market because we cannot afford to borrow or refinance anything. But if we just stay here around like 4%, 4.2, 4%, doesn't really change a lot. Like this, I don't know, the markets adjust to it. And it might be difficult to like really, really grow aggressively, but it's not going lower. So mortgages aren't coming down, borrowing costs aren't going down. That's a concern. I do wonder what December looks like because if the market starts to see that they cut rates again in December and the yields start to go higher, then here we are again. Fed's cutting, rates are going higher or yields are going higher. So is the Fed cutting for a third time and yields going higher? It is a red flag for me to watch this stuff over the next, maybe 6 to 12 months. Okay. All right. Average mortgage rate right now, 6.22. I think that is the 30-year fixed. Oh my gosh. So you can do a 1 to 5 year adjustable rate mortgage no, thank you. 622 is still pretty elevated. I don't know. We'll see. I mean, we're going to have to see some better inflation ratings. We're going to have to see some deflationary pressures. Shelter is coming down. Shelter is a huge component. I think it's like 40% of CPI is shelter related. If shelter rent prices are coming down, that could be a good thing for, the inflation lag to finally start showing like it's topping out. Right now, headline inflation and core CPI are both at 3%. Global PMI is on the rise. It's probably showing. Let me see if I can get a Fred PMI. See if I can get a reading on this. So this should be either St. Louis or Atlanta Fed, manufacturing, total construction, producer price index by industry. That's all manufacturing. I'm looking for like services PMI and manufacturing PMI. I just want a chart, man. All right, there's a lot of crap here. I'll figure it out. But manufacturing services PMI, if they're going up or global PMIs are rising, I think it's going to be difficult for yields to come down. That's all. And if Fed cuts again and yields go up, that's not a good sign. It's the rate of change that's really disruptive. So if it's just like a slow, steady move versus what we saw in 2024, that wasn't good. Even though we are well above those highs, right? September 2024 to where we are now, let's just compare that. SPX September 24, did the market even budge? So we had a pullback July to August. September, going into that rate cut, look at this. Fed cut rates and the market just kept going higher. This is September 2024. So Fed cuts rates, interest rates rise, bonds go down, fuels a boom in the equities market. We're up from that rate cut was all-time highs. I mean, the market rallied almost 9% to the end of the year, even though yields were higher. So it's like the markets don't care. Markets still have like plenty of tailwinds ahead. I just want to see that price supports it. I will grow cautious if we start to round out this top, meaning we take longer and longer and longer and longer without making really higher highs. So the longer this takes, the more choppy this looks, the more I'm concerned that a legitimate break in support will yield to a correction and a bigger correction. But if we're going to continue to make higher highs, I think that the pain trade is up and the blow off top that, I mean, if we thought that that little 3 or 4 day inefficient rally was one thing, look at like what gold did. You know, like could you imagine what this S&P does if we get like a hockey stick type move like gold? I mean, look at gold. If we are, this type of inefficiency starting in the S&P that we go into like bubble type territory, like that type of percentage is insane. This was a 30 plus percent rally. That's the type of bubbly move that I would say, yeah, it's a bubble. If we see a blow off top that's like 10, 15, 20% higher with virtually no pullback, then yes, I'm talking bubble, I'm talking caution, and I'm bracing for a correction that's inevitably going to happen. But if it's just, sideways and rounded out, it'll just take time. Maybe it rolls over. But I don't think we just go from current prices to straight up crashing. So if it's going to roll over, wait for kind of the structure to form. If it blows the tops off, enjoy the melt up and we'll see how ridiculous it gets. And then we'll have a correction. So, all right. Anyway, I will let you go for today. I just got an alert here on Pfizer. Pfizer's up to 25 and change. I'm looking to dump some of my Pfizer shares. We get up to over $30. I'm dumping those shares. Larry says DPP at 160 out at 36 cents end of the day. What happens? You just not manage to trade? Highs at 55. I don't think that would even fill. I had a 65 by 70. I don't think that would have filled up my dollar. So I'm guessing you went 10 wide there, Larry, and just kind of let it sit there. Should the shutdown end and data become available to rate cut? Speculation will gain momentum. Maybe. I have no idea what's going to happen with the data. Like if we open the government this week, are we going to see CPI and PPI print on Thursday, Friday? Maybe. I really don't know. And honestly, if it does print, does the market even care? Because what data are we pulling from? Is it CPI data from a month ago? Is it CPI data from 2 months ago? So I don't know how reliable it is. I have a feeling we're not going to see any news this week. I don't. When's the House vote? We passed the Senate, right? The Senate needed 60 votes. They got it. Now it's in the House. The House needs a simple majority. So that should be easier to get because the House still has, Republican majority. But I don't even know what the House vote is. So when does the House vote on the government shutdown? And again, the stopgap funding is only to like January 30th of next year. Will the vote today latest? Let's see. Are they voting today? A House vote today, Tuesday the 11th, reopen the government and the shutdown won't happen. Won't happen. Oh, there you go. Won't happen since the Senate and House not in session due to Veterans Day. Okay. Federal government could reopen as soon as this week when the House returns to vote the end of the longest shutdown in history. Senate approved. They got the 60 votes. They had like 8 Democrats that flipped on that one. Votes needed to pass. Now it's in the House. They need a simple majority. So shutdown, SNAP food stamps, back pay, things like that. We've got TSA. We got all sorts of disruption going on. People haven't been paid for over a month. Blah, blah, blah. Will not extend healthcare subsidies. Okay, it only guarantees a single Senate vote in December. How many Republicans support remains unclear. So maybe they vote tomorrow. So it's Veterans Day, not reopening. It's funny how they just, it's a federal holiday. Let's go ahead and take the day off as the government's still like shut down. Like, I mean, have you been working for the last 35 days? Anyway, let's see here. House will vote to reopen the government as soon as Wednesday, November 12th, when they return to session. So yeah, there's probably some catalysts and news this week. We'll see what happens. Markets are, back up, kind of clawing back from that gain from Friday. The market kind of started to spur that momentum on Friday's close. Should have passed the final vote, expected since Republicans control the House, expected to sign it, which point the shutdown would end. 60 votes, yes. Okay. So possibly tomorrow, as early as 4 p.m. Wednesday, November 12th. If they vote, if they pass, then we may see Thursday, Friday data. I have no idea. So I think it's a wait and see. One thing we might want to consider is hopefully the vote, whatever takes place, would be after hours. So one thing you want to keep tabs on would be the futures market. Keep an eye on S&P futures. Keep an eye on Nasdaq futures. I think that the shutdown is probably a good sign for stocks. It gets us back. Whether or not we like the data that's coming our way, it's better than having the uncertainty. And typically, like we saw with history of government shutdowns, the markets tend to be higher, and they certainly are. Governments. I don't even know when the shutdown started. What was it? October 1st? Is that right? Officially, like October 1st was a shutdown. So we're talking percentage wise. I mean, we had some volatility along the way, but the market's still higher. This is, where's the first at? So right in here, here's October 1st. So the market was up about 1.6, dropped that single day, and now back up to highs at 3+%. We're back up to current prices now. So the market from the government shutdown, longest in history, market's up 2.8%. Average historical move is positive, like plus, I think it's like 0.4 to 0.5%. S&P is up during government shutdowns, and it's up 2+%, almost 3%. So we'll see. So keep an eye on it. But like I said, if it's happening after hours, watch the futures market. If it comes in and the market clearly loves it and runs with it, then we're probably getting some gaps to the upside. Keep an eye on it. Okay, we will see. You're in a 50 by 70 10. Wow, I got you. Well, good thing it closed below 48. Or closed below your 68.50, Larry. Oh, baby. Flirt, playing with some fire, man. Yep, glad you got out. Cost over 12 billion so far. Yeah, I mean, okay, but also it probably saved hundreds of billions of dollars in the government not spending money. But all that's going to come back. And I'm sure it's going to come back. And, between government shutdown or the reopening and the Supreme Court just deal with the tariffs, whether it's unconstitutional, these are things that have to be resolved in the short term. US China, I think we could kind of put like a quarterly resolution on that US China is going to play nice. They're going to be frenemies. Optics are, not nearly as bad. We're not playing this like tit for tat trade war stuff. But anyway, things need to be settled. Longest government shutdown in history is kind of ridiculous. Let's get people back. Last week did feel really weird. Having like flight cancellations, layoffs. We're seeing like the Challenger job reports are showing like some of the worst layoffs since like 2008, since COVID. Like that's not a good sign. Like the temperature out there is pretty elevated. You can see why sentiment's so bad. People are just straight up concerned. If people are losing jobs now, my concern is that they're not coming back. And that's also what's really disruptive. With non-farm data, we haven't had a non-farm print. We've had ADP numbers that came in slightly elevated, and the market's like, oh, that's something to work with, but no non-farm. So I just wouldn't expect non-farm to print anything over 100K. We're probably going to have like 0 to 50K jobs in non-farm. And our, job reports, our JOLTS job openings, things like that are like low hire, low fire. We're getting like equal amounts of people leaving the workforce or getting fired and laid off and then joining. So it's kind of a zero-sum game right now for the labor market, which is not good. Anyway, not what we can control, right? What can we control? Our trades, our decisions, our risk. So we'll come back and do it again tomorrow. All right, I'll let you go for today's final hour. Thanks for being here. Tomorrow morning, Daily Profit Plan. I'll be live at 9 a.m. Eastern Time. Appreciate everyone jumping in. 9 a.m. If you want to follow me, you know how to get me. Telegram here, Discord, stuff like that. Come in and say hey in these live sessions. And tomorrow morning, look to trade. Okay. Peace out. See you. Have a good day. I'll see you tomorrow. Bye.